Good afternoon. Welcome to the AIIB annual meeting webinar. My name is Dong-ik Lee, Director General, Banking Department, Region 1 of AIIB. I'm delighted to take this moderator role for the session with the distinguished guest panelists from esteemed institutions in the region. Today, we have 5 guest panelists, and they are in no particular order. Mr. Abdullah Abubak, Director of National Infrastructure Fund, Kingdom of Saudi Arabia, and Mr. Karim Mourad, Global Head of Infrastructure, ADIA, United Arab Emirates, and Ms. Jennifer Powers, Partner and Chair of GIP Credit. Jennifer, especially thank you for joining us from New York. And Mr. Sami Nepati, Managing Partner, Aberdeen Investcorp Infrastructure Partners, and Mr. Najeeb Haider, my colleague, and the Director General, Banking Department, Region 2 of AIIB. Thank you all for accepting our invitations and participating in the session. The title of this webinar is Partnering with the Middle Eastern Institutional Investors in Financing Sustainable Infrastructure in Emerging Markets and Beyond. Somewhat a long title, but I'm sure the subject is very relevant, especially in views by the region's influential institutional investors. Private capital mobilization is one of the thematic priorities as per AIIB's corporate strategy. Private equity has the highest multiplier when it comes to the crowding in private capital from institutional investors. The bank has, therefore, a dedicated strategy on investing in equity, aiming at mobilizing capital to the desired infrastructure sectors to achieve societal impact at scale. As of Q1 2021, according to the joint MDB methodology on mobilization, AIIB has mobilized about $450 million private capital through 14 board-approved investments in private equity. Today, we take this session as an opportunity to bring private equity professionals together to discuss the role of private equity in emerging markets infrastructure sector, as well as challenges and opportunities for the asset class, particularly in light of the COVID-19 pandemic. The session will last 90 minutes, and we organize it into two parts discussions. Each part will circulate panelists to discuss the subjects, followed by about 10 minutes Q&A session. First of all, I'd like to ask each panelist to make a brief introduction and the description of their business focus. I'd like to request the orders are Abdullah, Karim, Jennifer, Sami, and Najeeb, without particular order. Thank you very much. Abdullah.
Thank you very much, Dong, and I'm very delighted to be here with you and with the panelists. So my name is Abdullah Abubakar. I'm a project finance by background, and now we have just established and announced the establishment of the National Infrastructure Fund, which is a development fund in the Kingdom of Saudi Arabia that has a mandate to crowd in private investments towards infrastructure projects in the kingdom. The way we plan to do it is by providing creative products to enhance the structure of the underlying projects, and also to ensure that we deepen the capital markets in order to diversify the sources of financing for these kind of projects. Our aim is to crowd in both local, and I mean here Saudi capital, and also foreign. The Kingdom of Saudi Arabia has a very good track record on PPPs and infrastructure transactions since 2005, but they were limited mainly in water and power. Our aim is to diversify also the type of sectors that we can, I would say, crowd in more private investments towards. That will include transport, logistics, digital infrastructure, and indeed the social infrastructure that includes education and healthcare and other sectors. Very delighted to be here again with you, and looking forward for a very fruitful and great discussion. Thank you, Tom.
Good morning and
Karim?
good afternoon. Oh, I'm sorry. Did I?
Oh, okay.
Am I going out of
It's okay,
turn?
Jennifer. Yes.
Oh.
Go ahead, please.
I'm Jennifer Powers. I chair the credit business at Global Infrastructure Partners. At the firm, we have close to 80 billion in AUM, all focused on infrastructure. About 5 billion of that is in infrastructure credit, and we are about to launch a new credit fund, which we're calling the Energy Transition Fund, which will focus on providing sustainable financing in the credit realm to infrastructure projects globally. We think this is incredibly important given what I call the tsunami of capital investment that is going into sustainable infrastructure. And on the credit side, there has yet to be, I think, a scaled fund that focuses on sustainable credit. And we think that's important because as an LP and providing the opportunity to invest in sustainable credit, we want to give LPs a framework by which sustainable credit can be scored, measured, screened, and ultimately reported on. And the concept of crowding in private capital really has to extend through the whole balance sheet, not just the equity side. And that's a significant focus for us here at GIP.
Thank you, Jennifer. Karim?
Thank you. Good afternoon, ladies and gentlemen. So my name is Karim Murad. I head up infrastructure at the Abu Dhabi Investment Authority. Just as a background, ADIA is the sovereign wealth fund for the Emirate of Abu Dhabi with a mandate to invest globally, worldwide. I joined ADIA as a founder member 14 years ago when we established the infrastructure division, and have really invested as of today into over a dozen countries across 4 sector verticals, and we all based out of Abu Dhabi. We have 25 people in our team looking at infrastructure opportunities everywhere. The sector verticals we look at have included transportation, utilities, energy, and digital infrastructure. And we are a large minority investor. We do not invest for control purposes. Asia has been one of our key markets over the last 5-6 years. We've got a substantial portfolio into India and have also invested into other Asian countries. Thank you.
Thank you, Karim. Sami?
Hi, everyone. Thank you for having me, Dong and Najeeb. It's a pleasure to be among you today. I represent Aberdeen Infrastructure Partners. It is a fund that invests in sustainable infrastructure in the GCC and the MENA region. It is a regional fund. It has been established by Investcorp and Aberdeen as a response to changes that we have been witnessing in this region. And the economic and social reform that has created a new opportunity for the private sector. And this obviously has been led by Saudi Arabia. We are a combination of the long and global experience of Aberdeen in infrastructure, and also the knowledge and network of Investcorp here in the region. We invest in 4 verticals. We invest in mobility, we invest in utilities, we invest in social infrastructure. I believe we are one of the only fund managers who has the ability to do that, and also digital infrastructure. We do brownfield and greenfield. We are a big fan of construction risk. We see ourselves, or we view ourselves, as a conduit for local and regional liquidity to take part in this new dynamic in the region. We are also a catalyst for FDI into the region at the level of the fund, and we are very glad that by PAF of Saudi Arabia and yourselves in the AIIB, I think that's the best manifestation of bringing FDI to the region. We also bring FDI through the assets that we own and that we invest in. We work with the best in class in each industry, and we bring them into our projects.
Great. Thank you, Sami. Najeeb.
Thank you, Don. Hello, everyone. It's a real pleasure to be here as a panelist in this group of eminent panelists. My name is Najeeb Haider. I'm Director General of Banking Region 2 at AIIB. The banking team is responsible for private equity in funds, investment format. We're responsible for financial institutions and syndications in banking as well. We're also responsible for capital markets and structured products. And the banking team looks after digital infrastructure. My background is also infrastructure. I joined AIIB about 5 years ago, and I joined in the policy and strategy team before I moved over to investment operations. And one of my primary tasks in the policy and strategy team was to help the bank put together the strategy for private capital mobilization. So I'm very excited about this discussion that we'll have with these panelists, as the key theme is private capital mobilization. So I'll stop at that and hopefully provide more detail as we go into this session on what the banking team is doing in terms of mobilizing private capital. Thank you.
Great. Thank you, Najeeb. It's great to have all the introduction session. And I think we are ready for the real discussion, the sessions. So as I said, we try to construct two batches of questions. And hopefully this will be very informative and helpful for you. Okay, the first batches in two topics. Let me go for that. The first one is based on your views and the business focus, what will be the opportunities, especially in the sectors and regions, and challenges investing in Asian emerging markets infrastructure, especially in pandemic period? That is one part. And second one, since we are conducting this annual meeting in the Middle East, so especially in investing in Middle East region, what will be the important factors that may be different from investing in, let's say, South or Southeast Asia? Okay, I'd like to go around, starting from Abdullah, and followed by Karim, Jennifer, Sami, and Najeeb. Thank you.
Thank you, Don. Let me, I would say, expand more on the first part, which is the sectors that have been more active, or we expect them to be more active due to the COVID-19 pandemic. In my opinion, I would answer this into two parts. The first part is, it was very obvious through the pandemic that there is a need more for resilience. And when I say resilience, I'm talking about the digital resilience in there. So many more countries have I would say, expanded more their KPIs towards having more connectivity within their countries, more broadband, more digital infrastructure to be embedded within their countries. Here, for example, in Saudi Arabia, we were a very good example of how the country responded to the pandemic through having a very good infrastructure in terms of connectivity. But that is not enough compared to the ambition that we have. So we plan to expand more on both broadband, and that includes, of course, 5G, and on data centers as well, that help and basically play a significant factor when it comes to resilience during pandemic. The question here is, many of the telecom providers for digital infrastructure see the significant lucrative opportunities, and they do not need any sort of a PPP, I would say, framework in order to do that. So they do it themselves in order to basically to capture, I would say, the significant value in there. However, in order for you to go to the less developed areas within a country, you need to introduce more creative and innovative kind of structures. And that needs perhaps a PPP model on a BOT basis or something of that sort. And this is an opportunity that I see that is being developed in a very, I would say, fast pace here in the kingdom. And I believe that this is also developed elsewhere. I know we're talking about the Middle East and emerging Asia, but for example, in Canada, they have introduced a PPP for broadband recently, and this is clear evidence that digital infrastructure is way important than what we thought, and we expect significant investments from both GPs or fund managers and developers towards this segment in the future. On the second part, which is the MENA versus emerging other Asian countries. To be honest, my information and my experience within the needs on emerging Asian countries other than the MENA is very limited. So I'll focus more on the MENA region, and I'll be also focusing heavily in the Gulf region, more specific. Most of the Gulf countries, including, of course, Saudi, have vision either 2030 or 2035 or 2040. And all of the visions, they have something in common, which is a growth in GDP. And that basically translates into a growth in investments towards infrastructure, given that infrastructure produces the significant productivity factors for economies. And that's not only in the, I would say, in the usual suspects of sectors such as water and power, but also in the social infrastructure such as education and health, etc., in order to meet the great demand that will happen with the GDP growth from both population and also in terms of development of these services. So I believe that there will be a significant opportunities here for fund managers. This could be met by also a de-risking from both multilateral and national development funds in order to crowd in more and more private investments toward these important sectors. Thank you, Doc.
Okay, thank you, Abdullah. Karim?
Thank you for the opportunity to answer. I'll focus on the first part of your question, but I think the same comments really apply to the second part, and specifically around the opportunities, the challenges in infrastructure in this part of the world. So if we just step back a second and look at how much interest and capital is pursuing infrastructure today, it's huge. I mean, there's so much money as a sector. It's growing. And that's being really translated into record fundraisings. It's being translated into record prices being paid for assets, and ultimately a compression in returns. When investors broadly like ourselves, when you look at Asia and you look at opportunities, what are you fundamentally looking for that's really different from some of the more global markets? I think it's really chasing the higher growth markets, chasing being able to achieve higher returns, either through underlying growth, which is gonna which is going to drive really the returns, sometimes through maybe lower pricing, but ultimately a market that's seen to be huge, that's likely to offer a huge pipeline, but that's not yet necessarily translating into that. In terms of where you would be typically, or what are the sectors that are of interest historically, and I think more globally, not just in Asia, but whenever a country typically privatized or concessioned or PPP sort of infrastructure opportunities has tended to be in roads. My personal view is fundamentally that's probably one of the easier subsectors of infrastructure. A road's pretty straightforward, and it tended to be the first area that tended to be financed privately. I think today, though, there's really two key themes that are driving investments across the globe and in Asia, and that's really the net zero, the energy transition, specifically for Asia, around both new power, but also trying to be greener, and digitization, which again fits in with my previous colleagues' comment around connectivity and so on. And within these sectors, we're seeing it in wind, we're seeing it in solar, storage as up and coming. You will see it in electricity networks, which are also fundamental. You will be seeing in digitization, we see it in mobile towers, fiber networks, data centers, and probably maybe less obvious, but nevertheless will remain important is the whole growth of the middle class in Asia, and that translates into opportunities in transportation that will also have impacts on real estate and so on. And it's whether you see it in airports, whether you will see it in roads and so on. We probably don't see as much in utilities, certainly within the areas we look at, but utilities generally looks at a slightly different sort of exposures, or you look at it from a different perspective as an investor. What are the challenges? What are the challenges I think most investors will sort of explore? Asia is a very large place, but it's also very fragmented. It's a lot of countries. It's done differently in each country. There will be different languages. So one of the biggest challenges is lack of boots on the ground. Certainly, if you're a global institutional investor, you may have some offices in major financial centers, but you're not going to have offices in every single country. And I think that tends to prove challenging from the perspective of deal origination, from the perspective of creating partnerships, building relationships, and so on. One of the other challenges, again, for the large pools of capital that are pursuing these opportunities, tends to be the size of deals. A lot of the deals have tended to be smaller. So from the perspective of multiple countries and multiple jurisdictions and regulation, you want scale, you want pipeline, and when investments are relatively small, it creates challenges. Now that can be addressed through platforms, and we see platforms being built in renewable energy. We see platforms being built in digital space, and we've certainly invested in some of these platforms and have helped build others. But that's something you need to be able to do to address one of these challenges. Probably the one of the most important points, and again, it's really a global issue when you look at infrastructure, is the need for stable regulation, stable legal framework, and transparent processes. Infrastructure assets are very sensitive assets. They sit at the interface between the public and private sectors. They affect people on a daily basis. They affect voters on a daily basis, which makes governments very sensitive about them. And therefore, you need to be able to manage the relationship with governments well, but at the same time, you need to, you're going to be investing into assets that need 20, 30 years of cash flows to justify their valuation. So you need to be comfortable that the regulation is stable, the regulation will remain broadly consistent, and you need to be comfortable with the legal framework, because in 20, 30 years, there will be disagreements, and you need to make sure that these are addressed consistently, transparently, fairly, in order to resolve any issues. And finally, transparency is also very important. A lot of the institutions that are investing are high quality institutions. Governance matters to them, and therefore it's very important that what they invest in doesn't risk, embarrassing them, that it's run properly, and so on. So thank you for that.
Great. Jennifer?
Thank you. I think this is a very interesting question, and I'm going to approach it through the lens of a credit investor, because despite the massive liquidity in the global markets, I think we have to remember that not all capital is playing for the same returns or the same upside in the case of equity investors. And credit investors are clearly just looking for a fixed return within a reasonable risk framework. And the point that Kareem just made about transparent and supportive regulatory markets is absolutely key. Even in countries that are putting in place legal frameworks and regulatory frameworks that are supportive of public and private partnerships, in many cases, their effectiveness has not yet been tested, and it will be a function of time. And I think it's important for sponsors, developers of these assets to remember that credit investors coming in need to consider a number of different issues, including what their opportunities are in what are, often lower risk home markets. And a kind of a case in point in terms of the challenges in investing in whether it's MENA or emerging Asia, is the other point that Kareem made around fragmented markets with different structural, legal, regulatory frameworks, is that there are not always clear precedents to follow. And in some cases, even the precedents that we can point to in a broader global context may not be directly applicable to the local markets. So, for example, in the case of not having a clear, strong investment precedent to follow, think about the telecom space, the tower space, still in its infancy, where government issued guidelines in many countries are just starting to evolve in the past 2, 3, 4 years. And we have yet to see operators do meaningful scale transactions in terms of sale and leaseback. So as we see more of these transactions, investors and credit investors will become more comfortable. In the case of the latter, where what we're used to in OECD or Western developed markets may not fit, think about what the standard PPA terms that we're seeing out of Vietnam Electricity or EVN that are offered to renewable developers that are very different from what we're seeing in OECD and other more developed markets, i.e. the lack of take or pay obligations, limited termination rights, due to political force majeure or default by EVN, no direct step-in rights. All of these things are going to impact the ability of credit capital to flow into the region. So I think that'll be a challenge, and where we'll look to the folks at AIIB to help us from a credit perspective, support these important initiatives.
Interesting. Great. Sami?
The first question, in terms of opportunities, probably it's worth going back to what happened in the region for the last 20 or 25 years. Private investment infrastructure is not new in the MENA region, GCC region, as Abdullah was pointing out. I think the first IPP, independent power plant, was built 25 years ago in Oman. And that asset has done a full circle now. It has been built, has been managed, and then has been returned to the government a few weeks ago, I believe. So there amount of investment in power and then in the desalination specifically throughout the region, and the has been quite good. If you have built an asset, if you have managed to run it quite well, you've been paid by the government, and you didn't have an issue with your public partner. And this is despite the countries, there were not overarching PPP laws. There were industry laws on which these assets relied. So that's the background. Given the change that the region is witnessing, and this has to be more investment from the private sector, and that the government should not be expected and cannot shoulder really the burden of the infrastructure investment on their own. The various governments have opened many new sectors, and that's an opportunity and a challenge. Abdullah was mentioning the digital sector, broadband, and what have you. We are seeing opportunities in the utility space and other sort of utilities. District cooling, for instance, which is a very important sector in this relatively hot region of the world. We have opportunities in mobility, metro systems in the region that will be managed as PPP, toll roads. We have opportunities in the social infrastructure, which is very new. Schools by the thousands in Saudi, by the tens in the UAE, entire healthcare rebuilt, and it's a combination of new build, but also of brownfield. So there is a need to refurbish these assets and give them a new life. So the opportunities are really across the board, and some of them are quite surprising in terms of being very progressive. Very recently, as a personal experience, on a public building, a court of justice. You see typically in Europe, one would have thought in this region that sort of asset would have been viewed as a symbol of sovereignty. People are being more pragmatic about it. It is a building. It is still the government that is providing the legal service. See the board, but that comes also with challenges. We see a difference between authorities that are very much used and have experience in managing PPP contracts, whether awarding them or managing through the life of the asset. And as Karim pointed out, in 20 or 30 years of relationship, there are ups and downs, and there are changes to the nature of the asset and the nature of the service or the volume of the service it provides. So there has to be an ongoing discussion between the private sector and the public sector partner. So authorities that are dealing with this whole theme of PPP and private sector, sometimes they don't have the experience. They are learning. There are certain teething issues. Now, the answer to that is just to be patient, really. If you are patient capital, if you are in this region to last, and your investment horizon is not 3 years, then you are very well set to not only reap the benefits, to kind of walk that walk with the government officials and the authorities, because some people, we have a healthy level of interaction with the private sector, welcoming ideas, welcoming suggestions. We have seen a multitude of assets, the private authority reaching out to the private sector and having a far-reaching consultation on what this asset should do, how it should look like, whether the contractual obligations and from one side or the other are actually up to the international standard. The pandemic specifically, and I live here, so I've seen it unfolding. For the first few weeks and 2 months, it created a challenge in terms of even construction workers not being able to be on sites to continue building. But then very immediately, it has reaffirmed the desire of the various governments to continue in even a stronger manner the private sector. The pandemic has created dislocations. It has put tremendous pressure on government resources and budgets, so that very strong trend towards private sector contribution, we have seen it really reinforced. There is a powerful drive for green energy, for renewable in the region as well, and that is, I think, is an attractive opportunity, but depending on your return appetite. I think if you go to utility scale renewable, it's probably in the single-digit return, and that might be convenient for certain very large institutions. But quirkier, nimbler projects that are still in the renewable space command high returns. The second question, which is how do you compare the Middle Eastern countries or the kind of the GCC countries to Southeast Asia? There are a number of factors. First, as Karim pointed out, here in the region, despite the limited number of countries, we deal with country by country dynamics. It is true that we see throughout the region a desire to include the private sector, but every country is going about it in a different way. First and foremost, you have different credit ratings. If you are in the UAE, if you are in Saudi, if you're working with Qatar, then you definitely have a very high quality of take, which is probably not very much available in Southeast Asia. If you are dealing with the government authority in Saudi or in Abu Dhabi, or if you're dealing with ADNOC or Aramco, you have top quality credit standing behind these obligations. As a field can experience some delays if you are dealing with a government institution that is just starting on this path towards PPPs. Probably an advice is to always have a very capable local construction partner, because that does matter, and that really matters on a daily basis. Thank you.
Great, very interesting. Thank you, Sami. Najeeb.
Thank you, Don. I think the earlier panelists have covered almost every aspect of financing infrastructure that there is to cover. So I'll probably focus on a few issues and how we think, from an AIIB perspective, we can facilitate private capital. It's very interesting that Abdullah and Sami both mentioned their appetite for construction risk and for new technologies subject to pricing. That's very interesting. But what I've noticed is that this type of appetite from institutional investors is usually only for their home markets, not so much when they go broadly overseas. So that's one. It's also very interesting. Karim outlined the framework for PPPs and where they've succeeded. I absolutely agree. You need a regulatory framework that works. You need a set of contracts that have been tested. You need open, transparent bidding. And therefore you get equity interest. And once you have equity interest, you get debt. What I would like to add to that is that that's a good framework. That's a good framework for risk allocation. The additional component that is very important, that stands the test of time, is appropriate economic allocation. So as long as the economics are also fairly allocated amongst the parties involved in the project, those projects usually tend to stand the test of time. And Jennifer also highlighted from a credit perspective what investors look at, and PPP has been mentioned a few times. And I would say that even beyond PPP, even if a country does not have a formal tested public-private partnership framework across a few sectors, every infrastructure under will involve some kind of government interaction, either in the form of provision of land or rights of way or fuel or offtake. So there is going to be government involvement. So there is the requirement for a regulatory framework, contracts that work, and a track record of the government upholding its obligations. And that's where I think the difference is between various countries in Asia and various countries in the Middle East. And the difference is in it's economies the countries are in, the relative capacity they have, and the capacity is ability and intent to uphold contracts. So that's where the difference is. And what we in AIIB are actively trying to do is partner with the right people in the countries that we operate in. We have partnered with Sami in a fund that hopefully will demonstrate how we work together with the private sector. And we have also, I'll give just to wrap up, I'll give an example of how we're trying to address some of the concerns institutional when they look at emerging markets. So Jennifer mentioned certainty of returns, and there's construction risk that Abdullah mentioned. There's risk of contractual arrangements that have been talked about. But also it's the format of investment. So many institutional investors like the liquidity of the capital markets. They like the ability, even though they may commit to a long-term instrument, they like the ability to be able to sell it for liquidity purposes if required. So what we have done, and this is the first in Asia, maybe first globally in emerging markets, we invested in an equity platform called Bayfront with Clifford Capital from Singapore. The objective of this investment with Clifford Capital was to mobilize private capital in emerging markets globally. Most of the greenfield infrastructure is invested by commercial banks. As we all know, commercial banks coming under increasing regulatory pressure, and long-term sub-investment grade liquidity for them is challenging. But they are quite comfortable taking construction risk, analyzing and taking construction risk. So what this is, they acquire debt from operating assets that have a year or two of operating history in the infrastructure space. We warehouse it for a year or so and then securitize it. And the first successful securitization, so we put in 40% equity in the joint venture, and then he anchored the first public issuance in June this year. It's a $450 million issuance, and we anchored provide about 100 million of liquidity. And so what this does is this provides the banks, hopefully going forward, the certainty that after they can sell their exposure to this entity. And what this does for institutional investors is provide certainty of returns, because this is an strong investment grade rated exposure. It's a portfolio, and it's a portfolio of operating assets. So there's no construction risk or very limited construction risk, and it's a term exposure, stable operating term exposure, appropriately priced. So we're thinking of solutions on these lines, and each market is different. Each country will have its own requirements, but as long as we're able to deploy balance sheet smartly, work with our partners, we think we can find solutions that suit our member countries. Thank you.
Thank you, Najeeb. Okay, we finished the first batch. We went around all the panelists. Before we go into the second batch, I think I found it very interesting and informative. And what I kind of found, kind of common area you all touch upon as an investor, especially the sovereign invest fund of the list. I found it the majority of what you mentioned, the digital infrastructure in AIIB categorized ICT sector. So I like to ask the kind of derivative question to especially Abdullah and Karim as an institutional investor. Is that the portion of a portfolio of this ICT sector will you expect to grow, or just taking this position as of now because of it was already expanded rapidly? And second question is the data center. This is a specific question. Of course, we're going to come back and talk about some environmental issue, but there's an interesting balance because data centers consume a lot of electricity, and some of our member countries and some the investors having trouble to balance between energy consumption, especially from renewables, and at the same time we have to invest into the data center. So I'm just curious whether you have that kind of experience in your portfolio. So I think it'll be interesting to share your experience. Abdullah?
Sure. On the first part of the question, Dong, whether this is only a temporary spike in the infrastructure need towards digital, I think if it was for water or power, it might be, because these are sectors where usually infrastructure needs spread over a longer period. However, for digital, I believe, especially data centers and broadband, I believe this is a continuous pattern that we'll be seeing in the coming years. It might even increase. On the data centers in specific as an asset class, it's an early asset class here in the kingdom, to be honest. So it was done previously by telecom providers, but banks here in the kingdom, they are not very familiar with these kind of assets still, especially if it's not attached to a proper offtake by the anchor tenants for these data centers. So they wouldn't take the construction risk at all for these types of transactions. Whenever there is an anchor tenant, they might be refinancing some of the equity or something of that sort. In relation to the consumption of electricity, yes, it is. And while the kingdom has announced a couple of days ago the net zero by 2060, it means that we'll be seeing more of renewable and clean energy introduced to the space, either through solar or wind, for these types of data centers. Of course, we don't expect it to happen in a day or two. This will be a natural progression for these to be clean.
Okay.
Here in
Thanks.
the kingdom.
Karim, would you like to add?
Yes, thank you. So look, I'd agree with Abdullah. I think digital infrastructure is here and will grow. I mean, you have to look at maybe a few years ago, most investors probably would have had minimal, or most infrastructure investors would have had minimal or no exposure to that sector. Whereas you look at today, you look at the deal pipeline globally, it's probably the most active deal. Well, with renewables, it's probably the most active sector for deals. I think what we've seen during the pandemic is really an acceleration of what would have eventually happened, and has really brought forward. A quote I heard basically, talking about these new, sort of the new fiber networks and so on as the future, as the railroads of the past that we talked about. So I think clearly it's seen as a sector. And I think it's also offers something, certainly today, different to a portfolio. It has different exposures to traditional infrastructure portfolios. So there are diversification benefits. There are lower correlations that do help. When it comes to data centers, I think it's really similar trends, whether it's data sovereignty, whether it's sort of huge volumes of data, you're going to see that continue. I think to address the issue around energy, we probably see more and more people thinking around combining renewable sources of energy with data centers. People are talking about it, and I think that probably is the direction we'll head into. And I think within data centers, you've clearly got very different risk profiles, and there's some data centers fit within a private equity portfolio, some fit within a real estate portfolio, and others fit within infrastructure. So I think it's actually very, very large and will continue to grow, in my opinion.
Great.
Thank you.
Thank you, Karim. I think this will be the first round of first question, batch questions. I think I found it very interesting and very insightful from all of your panelists. Why don't we move to the second batch? I think you already got the topics, but I'd like to share one more time. Okay, the second batch will be number 1. What additional values to expect multilaterals such as AIIB to cloud private capital into the region? So not just the values, but also the roles, or what would be the better position, or we have to do some other direction for AIIB to attract more capital into the region. That's one. And the second one is, of course, we have to discuss about the ESG aspect. What is your perception based on your institution? Or ESG is a very wide spectrum. Then multilateral, so there's no question. We have one of the top priorities. But your institutional views on ESG and the sustainability for infrastructure, especially when you make the review and make the investment decision in this asset class. Let's start with Jennifer, followed by Sami, Karim, Abdullah, then Najeeb. Thank you.
So thank you, Dong, for the question. In terms of how do we lean on you and other multilaterals to bring in more private capital? In terms of what I think of as the role of multilaterals, it's really to a certain extent demystify the risks and also the opportunities for private capital, given that you are, I think, to use Kareem's earlier point, boots on the ground. And when we think about infrastructure being in the service of communities, the constituencies of infrastructure, it's critical to understand the local environment and partner with folks who are very much present across the full range of applicable stakeholders. One of the things that I think we all need to kind of lean into is to help local governments and regulators understand best market practices and help design systems, legal, regulatory, that can facilitate capital, as opposed to the many different threads that can kind of go down the wrong path and then have to be reoriented to be more financeable. In terms of existing technology, obviously you all have done A loan, B loan structures. The concept of taking a first loss position, and I'm speaking from the viewpoint of a credit investor. Looking at how you can help de-risk certain opportunities, in particular around FX risk, and certain contractual frameworks that may be less palatable to Western LPs. I think that can be very, very helpful in terms of facilitating foreign investors and lenders. And taking a page from some other multilaterals, including, for example, the AIIB, who had pivoted many years ago to helping investors understand that they were going to behave in a very commercial way and not be kind of captive to whatever the then current political environment is. In terms of the question of sustainability and what does it mean for our firm, Global Infrastructure Partners has, as I like to say, been focused on ESG long before ESG was cool. We have a very strong history of tracking, monitoring, and optimizing KPIs within each of the ESG pillars. As I mentioned at the outset, one of the challenges I think about with regard to mobilizing private capital is to embrace what that means for credit investors. As an equity investor, in particular as a control investor, when you own the company or own a majority stake, you can really have a hand in shaping ESG policy. However, think about it from a credit investor standpoint. If those policies are not robust and in place, you rarely have the opportunity from the the back of the bus, if you will, from a credit standpoint to proactively drive ESG outcomes. And one of the things that we're focused on in terms of the credit products that GIP offers is how do we get in on the front end, use our operating team and our ESG teams to shape the ESG dialogue and to put in place the covenants, the framework, the reporting necessary so that once we sign the documents, there are ESG rules of the road. Because over the lifespan of a 5 to 7 year loan, we're going to have to rely on the structuring and the diligence that we did up front. And I think that grappling with that from a credit investor standpoint and the ongoing dialogue that we have with our credit LPs, it's becoming a bigger and bigger issue as to how credit can play an active role in molding the outcome of these financings. And being aware of the broader global mobilization of capital from your seat, Dong, and it's, I think I cannot underscore the importance of being aware of, say, how a European investor thinks about, say, European taxonomy, and whether their investment in an emerging Asian country is going to align to their broader objectives in their home country or in their home region. So awareness of global ESG constructs from a regulatory standpoint and how it affects investors will be increasingly important.
Great. Thank you, Jennifer. Next is Sammy.
Thank you, Don. I think in answering your question, I should probably use the experience that we are going through following your investment with us and that being made public, and what has that done in terms of the perception of local and regional investors and international investors. I've seen it unfolding. I've seen the seal of trust and the vote of confidence when you have a very large development institution such as yourselves invest. I think people have more confidence in terms of governance, in terms of ESG aspects as well, and the respect of that, and we'll come back to that. I think it also raises awareness because people are generally fascinated. Why would a very large, and now the second largest development institution, come to the region and invest in a fund? What are they seeking to achieve? And just raises awareness. Just by asking those questions, it raises awareness. And it is really one of the most frequent questions that I get when I speak to investors. So it does help change the perception and attract other investors. As one of the things that this fund has tried to do from the onset is to create a corridor of investment between Asia and the Gulf. And we've been talking to a lot of Asian investors in Korea, China, and other places. And I think other investments by development institutions helps that discussion. It answers a lot of the questions they have around the region and the opportunity and the governance and the political risk and what have you. So that is very, very helpful. I think the other thing it does also is simply attract other multilaterals that have not looked to invest in this region before. And some of them are international multilaterals. Some of them are regional multilaterals that have not invested in the GCC before. You have single country development funds that are quite powerful that have invested in Asia and Africa, but have not invested in the GCC countries. And now they have taken notice that something different is happening. The AIIB is investing. It's a part of my peer group. Maybe I should look into this as well. So the multiplier effect is real. We feel it. Again, the confidence and the trust that you project when you have a very large, significant development institution with you is real. Coming to ESG and what it means to us or how we view it. First and foremost, we are an emanation or a child of InvestCorp and Aberdeen standards. So obviously we are subject to all the policies they have to live with. That as a start. Secondly, we have you as an anchor investor, and other development institutions are seriously contemplating joining. So we had to work with your teams to have probably the best in class policy, risk tools, ESG management system that is really embedded into the investment process and then the asset management. And that starts really by the selection of the deals and the first evaluation throughout. Jennifer started talking about the influence you can exert. And obviously we work within consortia. At the moment, I can tell you about live discussions we're having with consortiums or consortia with whom we are working. And these are different. Sometimes you're working with a very large European industrial infrastructure investor who would have the same mentality, be subject to the same policy. So it's an easy conversation to have when you try to implement from ESG considerations and how we form the consortium, how we look at the deal, how we deal with our construction partners, how we deal with the technical advisors we get, and everything that we need to deal with and address. Sometimes you're working with regional partners or local partners. They understand that there is a topic in the world called ESG, but maybe it didn't trickle down to them to alter and change the way they have been doing business for decades. And this, to me, puts us in this interesting position where we have to, and we believe that we need to abide by ever-evolving set of principles and rules, while staying connected with the region in which we operate, help in our very limited and modest capacity lift the environment without being completely disconnected from that environment.
Okay. Thank you. Karim?
Thank you, Dong. So what I'll say is probably going to be a bit repetitive, so I'll keep it brief. In terms of what do you guys bring to the table? I think there's lots of things, and they're all beneficial. It's really presence on the ground, which I talked about as being potentially an issue on the previous question. I think having you there, whether explicitly or implicitly, provides political risk cover, especially in a sector where regulation and legal frameworks are so important. I think having you there will make counterparts think twice around perhaps doing things that are maybe to the detriment of investors. And I think there is comfort when a particular project or a particular investment has met your high corporate governance standards. So so there's a lot of comfort that overall you bring. As for the ESG question, we've also, to be honest, been looking at the E, the S, and the G, although not as ESG in the past, and we don't look at it as a box ticking exercise, to be honest. Infrastructure is a long-term asset class. You need 20, 30 plus years of returns to make valuations work. And so when you're looking at these investments, you're looking at them as from a long-term economic sustainable point of view. You need, to make your return, the investment has to be sustainable. You want, and for the E, you want to understand the risk of a stranded asset, because that's a problem from a financial return perspective. And you also want to position your asset for growth. So really, ESG comes down to the fundamental investment thesis and to the economic sustainability and the returns, although I think hasn't historically been termed as such, and is really a very important exercise, not just purely a box ticking exercise. So from my perspective, thank you very much. That's it.
Great. Thank you, Karim. Next, Abdullah.
Thank you, Don. I'll start with the ESG first, if you don't mind, and I'll just echo what my colleague Karim said. It's beyond only a checklist where you're ticking the boxes, but in the same time, it's important also to have a standardized ESG framework among everyone. So any country or any procurement agency or any, I would say, PPP center of excellence, ensure that they are in compliance with the ESG globally. So what ESG for China might be different for ESG for America, for US, for example, investors. It might be different from the European investors. So similar to what we are having, for example, in the documentation with the Loan Market Association in there. If something happens for the ESG, I think that will clear a lot of the ambiguity around it, to be honest with you. This is one in relation to the ESG. In relation to the first question, it's in my opinion very. I mean, I can't add a lot. My colleagues have, I would say, said all what I wanted to say, but it's important for the multilateral and the national development funds to be, I would say, agile and structured with their offerings, in my opinion. Every single transaction differs from the other one, and every transaction has its unique risks that could be de-risked through different products here and there. Of course, having a very strong framework and due diligence process is very important because it will provide further comfort to the other investors, but also to target specific risk also is as important, in my opinion. I know that this balance is a bit hard to do, but I mean, if it's done, in my opinion, it could add a lot of significant value. Thank you, Don.
Great. Najeeb?
Thank you, Don. I'd like to take this opportunity to thank Sami for his comments on the partnership that we have and the impact that AIIB's partnership is hopefully having on fundraising and bringing in additional private capital. So thank you, Sami, for mentioning that. And the reason I would like to thank you again is it highlights what we are trying to do as a multilateral. We can demonstrate, and I'll give a couple of examples of what multilaterals can do and how they can successfully finance transactions and hopefully bring in more private capital, not only to that particular transaction, but to our member countries in those sectors and other sectors related to digital infrastructure, which is an important thematic priority. So we have 4 thematic priorities. ESG so sustainable infrastructure is the first one. So environmentally, socially, economically sustainable infrastructure is core to everything we do. Our second thematic priority is connectivity. So infrastructure that provides economic connectivity is something we focus on. Our third thematic priority is private capital mobilization. And the fourth one is supporting the finance of digitally enabled infrastructure. So what I'll do is I'll give a couple of examples quickly and hopefully demonstrate what AIIB is doing in terms of bringing multilaterals capabilities to bear in helping our clients successfully finance infrastructure projects of scale. The first example I'll give is a satellite project that Don's team actually in Region 1 banking financed in Indonesia. This is a very good example of a public-private partnership. It's probably one of the 2 ever globally PPP transactions in the satellite space. AIIB came in as a lead arranger. It was an interesting discussion with the sponsors initially because they were a little bit reluctant, given the perception sometimes that multilaterals are slow in their approval processes. In the end, AIIB was ahead of even the commercial lenders by a couple of months in getting all our approvals. And this process, it's in Indonesia, so Indonesia is a very well-regarded jurisdiction from a public-private partnership perspective. Since the early 90s, they've had very successful PPPs in the power space. Although this was the first PPP in the satellite sector, the jurisdiction from a regulatory regime perspective, contract honoring perspective, is quite well regarded. But we did face challenges. We had an insurance event, and as we know, satellites greenfield have the risk of the rocket not reaching its destination. In this case, a rocket that was manufactured by the same supplier that is manufacturing the rocket for this company actually blew up. So, and which happens. But all the financiers supported by AIIB analyzed the impact of that, and we stayed with the deal. We financed the deal on time, so we didn't get worried overly by the event. We made sure the insurance package was good, as we would as the prudent lender. So that's one example of successfully financing a PPP project. In that project, we provided debt. And then the other extreme in terms of risk profile and returns is a project that we financed in China as an LP, which is a fund that will use artificial intelligence. It's one of the global leaders in AI we will use artificial intelligence, invest minority stakes in operating companies, and using AI, improve the operating performance of those companies, and then hopefully improving our equity valuation. So these are two extremes I would say in the digital space. One, contracted debt project in a PPP construct. The other one is equity investment in AI enabled infrastructure. So and everything in between, like data centers, would be of a lot of interest for us. And we're actively looking at data center projects. And as Abdullah mentioned, there are some that it's a key theme, one of the key themes in digital infrastructure in Saudi Arabia. So we'd be very happy to talk to Abdullah, you about these projects and see how we can work together on these. So it's a whole spectrum from senior secured debt to equity in AI-enabled infrastructure. So we, from a multilateral development bank's perspective, what we would like to do is demonstrate what value we can add by actually doing deals, interesting transactions. So I'll leave it at that, and I'll be happy to answer questions on these deals or more that we're looking at if the audience or the panelists would like to ask.
Okay, Najeeb, thank you very much. Thank you all for panelists. I think this is a very fascinating session. We went around the second round of questions. I hope that those are very informative, and we learn a lot also. But we also share a lot of knowledge and experience among ourselves and including our audience. We have about 15 minutes left, so slightly we finished the second one a little bit earlier. So it's great that we can have some Q&A session from now on. And in fact, we're getting questions from the audience and through some our system, right? And there are a couple of questions I found interesting. Let me take a kind of discretion to choose some questions. We'll discuss this until the remaining time permits. Okay, the first one is, since you are our investor in both equity and debt, and at the same time you are based in the GCC countries and the Middle Eastern region. So question came like, what do you see down the road in infrastructure area? What would be the most attractive area or sectors in terms of a risk return perspective? And of course, the considering the legal and the governance perspective for both debt and equity. So I think it's an interesting question. So maybe you take advantage of having all of you from GCC countries. So I'd like to hear from your opinion. So we're going from Abdullah, Karim, Jennifer, Sami. If you're comfortable, you can answer. Otherwise, we can still.
Yeah, I'll defer this perhaps to my colleagues. They might add, I would say, further clarity on the type of returns among different sectors more than I do.
Okay.
I can have a short attempt, although probably with a disappointing answer to the person asking it, in that there's probably no straightforward answer to that, to be honest. It'll depend on a lot. To an extent, the most popular sectors today are sectors that are sort of tapping into net zero and that tapping into digitization. But then there are also the sectors that really have so much capital pursuing and that have driven where you've seen returns driven very low. Now, that's not to say that other infrastructure sectors have higher returns. I think this complexity in terms of looking at something like this depends on the country, depends on whether there's growth or no growth, and so on. So unfortunately, probably hard to give a straightforward answer to that one.
Okay. Anyone wants to add that?
Sure. Sure. It's it's a question that I absolutely understand. It's something I face on a daily basis when you go out and fundraise for a GCC and slash MENA, but more tilted towards GCC. What do investors like? Or what do they want to do? And as Kareem mentioned, it really varies. If you're talking to a large pension fund, to a sovereign wealth fund, it's very different from what a private family office would seek to invest. But Kareem also started mentioning that there are themes that people like. They're quite popular, renewable sustainability. But as Kareem said, these are really under pressure. So you have to look within that space at the differentiating factor, and that could be technology. So waste to energy commands a better return than utility scale PV. District cooling as well, I would probably put it under that banner. Few things that many investors shy away from: construction risk. A lot of investors don't understand it, don't like it, and we spend a lot of time explaining how this is managed and the advantages when you have the arbitrage construction to operations and the advantage of that. Because many investors are looking for immediate yield. And I guess what we're trying to offer within the portfolio construct is a balance between yield and also an upside, thanks to very well managed construction. I think also size matters to certain investors, especially if they are very large pension funds or sovereign wealth funds. They would tend to look at the opportunity to deploy large tickets, and also having co-investment rights where they could deploy more. So you tend to try to see whether there are large deals that you can bring to them, or offer a sort of platform strategy where there is a succession of deals that look exactly the same, that you combine in a platform of 4 or 5 assets to make it really worth their while. But the overarching answer, really, the appetite is very different, and everyone is looking for yield.
Okay. Thanks. Anybody wants to add that question? Okay. Thank you. Thank you for your contribution. I'm reading one question I just received. I think this is relatively similar to the difference between the GCC countries and the other regions. But this particular question stating how in investing infrastructure in emerging markets different from OECD countries. What about the difference in return premium? I think this is a kind of a interesting aspect of all you're facing because you're covering all the global basis. So,
yeah, do you want to
start with this?
Yeah, based on research, not based on experience. Yeah, I have done quite research on the type of premiums, on the IRRs for infrastructure transactions on average between emerging developing markets and developed markets. So on average, we see that it's a single digit in the more developed markets, 9 to 11, I would say. In developing, I mean, and not everywhere, of course. In very developing markets, we see it could reach to 17 to 18% in terms of IRR on average. So I hope. I mean, this is more of kind of implicit answer, or sorry, explicit answer, I would say, that could satisfy the asker.
Don, if I may add to that.
Yeah, sure, Najeeb.
So I agree with Kareem. I think I agree with his research-based findings. I think what I would like to add to that is partly based on research and partly based on experience. I think the OECD markets and the broad differences are not so much in reality in terms of pricing, but also perception-based. So both S&P and Moody's have done research over 3 decades that indicates that infrastructure as an asset class is quite stable, even through difficult times, through crisis periods. And even if an infrastructure assets gets into difficulty, then the recovery rates are almost 100% higher, or twice as good as similarly rated corporate exposures. So I would say, as an infrastructure professional who's practiced mostly in emerging markets, there seems to be a misperception of risk in emerging markets versus OECD. And the misperception is primarily based on the country risk perception. From a commercial structuring perspective, deals go bad in emerging markets and in developed markets. And that's based on the misallocation of economics. This is something that I'd highlighted earlier. So it almost does not matter which country you're in. If a deal is structured to overcompensate a particular stakeholder, it will not stand the test of time. And if the economics are appropriately allocated, then in all likelihood, it will stand the test of time. But the pricing, the main differential in pricing comes from the perception of country risk.
If I may add to that, Najeeb, because I think that that's extremely on point. From a credit perspective, I've experienced more workouts and challenges with our investments in North America than I have anyplace else. And the perception issue is very real. I think what we look to is not to put a bracketed, we're looking for X% premium to where we would get in the home market, but we're trying to get as specific as possible in each analytical framework based on the attachment point, the level of equity cushion, the quality of management, the quality of the local market regulatory and historical practices. So it sounds a bit overly simplistic to say that we look at each situation specifically. But indeed, that's what we have to do, because even from where we sit in the U.S., the legal framework is not without its own risks, and the economic drivers of a project, have to be compelling to the sponsor, to the off-takers on their own economic merits for the investment to be durable and resilient through various cycles.
Maybe I'd add a couple of points, just from probably much more from experience, I guess, than from a research perspective. And it's maybe linked, similar answer to my answer to the first question, which is really, it depends. And I think as Jennifer said, depending on the project, depending on the risk, the regulation, the management, and so on. But then stepping back a second, a lot of investors, at least the starting position when you're looking at returns and so on, is looking at it, from a CAPM type approach, and to an extent when you're trying to look at your your risk-free rate and comparing certain countries, you probably initially will be basing it off the capital markets, and at least looking at what the capital markets perception of the underlying country risk is, and all else being equal, that typically will have a differentiator between emerging market country risk and developed market country risk. But then there's many other factors that come into play, which really and are driven to a large extent by supply and demand. There's some emerging markets where there's a huge demand for infrastructure, perhaps because they have very large pension system that invests in that sector, which really drives returns lower. And if you simply look at a comparison between spreads between risk-free in that market versus a developed market, it doesn't necessarily stack up by itself. There are other factors. For example, in some markets there's no long-term government bond or equivalent product, and so people see infrastructure as a proxy, and you see again a lot more interest in infrastructure that will drive returns and makes the spread lower than it needs to be. So really, it's hard to sort of to take a very simplistic look on it, other than to say, look, to be honest, from my experience, things that tend to go wrong in some emerging markets project are probably less to do with the project and more to do with country-specific issues, complex permitting, increased bureaucracy, certain changes to the economy, FX risk, which can be an issue if you're unable to issue debt in the local currency of the project. At the same time, regulation, you can say to an extent, can maybe counterintuitively tends to be sometimes more stable in developed countries because governments recognize the importance of attracting capital, and then recognize that you have to look after that capital. Perhaps in some developed countries, where there's a lot of capital floating around, maybe regulation can sometimes be disregarded just because there's so much money and they can afford to do so.
Yeah, Karim, Don, do you mind if I say something?
Oh no, please go ahead. Thank you.
Yeah, so Jennifer, Karim, I mean, totally, I agree with you. It depends on a lot of things, and providing figures could be misleading big time. But in order just to quantify or to answer on basically a question in a very simple way, if we look at the fund managers and if they want to invest in the emerging markets versus if they have, for example, a sidecar or a fund that invests in the developed countries, what would be the premium on average between those? So just to give basically whoever asked and the audience some sort of, I would say, a simple kind of figure, just to show the premium.
Okay, great. Thank you, Abdullah. I really appreciate. I think we have only 2 or 3 minutes left. So my apologies. I found a number of interesting questions, but due to our time limitation, I think it's about time we close this very interesting session. And depending on the issues and questions, then definitely we have a chance to have a further continuing discussion with our panelists, and we can have another session to come back to you. Thank you very much, all of you. I think it was a wonderful session, and especially different time zone, like Jennifer. I really appreciate your participation, and I think it's very useful and very insightful, and especially your active participation and contribution. So thank you all, and this will end our AIIB webinar on this interesting area for today. Thank you, everybody. Have a wonderful day.
Thank you.
Thank you.
Thank you.
Thank you, Don. Thank you all.